Get ready for more valuable financial insights from Northern California's premier retirement income planners, Dan Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
Welcome to the Peak Financial Freedom Hour. You're here with Dan Ahmad and Jim Files. We'd like to welcome everyone to the show. We know a lot of people have listened for weeks, years, even decades, and you've heard a lot of information. We want to welcome you and make sure you know at any time, if you need help, feel free to dial pound 250 on your cell phone. That's pound 250, say the keyword money. You can get a hold of us and we can see if we can provide you some information. And we also like to just thank you for listening to us. You also can go to our website and listen to our podcasts, which are previous radio shows, as well as going to our website and watch our TV show. And there's multiple shows you can watch on there because we don't do an infomercial. We do 13 new shows when we do a new season. We have a great YouTube channel that you can get some information from. And again, don't hesitate, call us. We have people that call 5 years later after they started listening to us and said, tell us, they just think it was time. We say, okay, great. You let us know. And one of the things that we want to make sure that people know is that things change drastically. When you were saving money for retirement, it's a different mode than now when you're retired. And now looking at how in the heck are you going to replace your paychecks and how in the heck are you going to make sure it doesn't run out? So a whole different ballgame now. You can't do the same things you used to do. So if any people are out there saying, yeah, continue to invest the exact same way you did when you were working, it really just doesn't make sense. So Jim, why don't we look at some financial wisdom of the week?
Okay, Dan, this comes from George Bernard Shaw. He said the single biggest problem in communication is the illusion that is taken place. And that is so appropriate for everything that we communicate here on our radio show, our podcast, if you meet with us in person. It really starts with a number of areas, and I'll pick out one. I'll just talk about risk. Communication is an illusion that has taken place. And the illusion is that I would say 95% of clients that have in portfolios of stocks and bonds, they have an illusion that their risk is very small or they might not lose too much. And we talk about income planning on our show because that's what we do here, but we can't successfully income plan unless we control the risk. It's impossible. We can make the numbers look any way you want them to look, but unless you can control that risk, there's no way your income plan is ever going to work. And you're going to go through retirement very stress. So the illusion, Dan, right now, with almost everybody that comes in, when we ask them, Mr. and Mrs. Client, how much risk do you think you have in your portfolio? Or let me clarify that. How much do you think you could lose in dollars and cents in the event the market drops by 30 or 40 or 50%? And Dan, what's their answer?
They usually say, I'm conservative, I'm moderate. I don't think I can lose more than 10, 15%. Sometimes they might squeeze it to 20%. But, it's 1 out of 100 that'll say 40 or 50%.
Yeah. But when they say 20%, and let's assume the clients have $2 million. When we convert that into dollars, even if they say 20%, which is rare, that's $400,000. So imagine you're 65 or 67, you're retired or about ready to retire, and you lose 20% because you're comfortable with that. That's what you tell us. But then we convert it into dollars and cents. We said that means it's $400,000. And imagine meeting with us in 3 months or 6 months or a year in a review meeting, and you're down $400,000. How would you feel?
Everyone would feel terrible. If that's me, I'm going to feel terrible. And what you said earlier, everyone has that illusion that they have minimal risk. And the simple reason is because that's what they want to believe.
Yeah.
You want to believe you have minimal risk because if you go into retirement and you have to admit that you have moderate high risk, that means you're going to freak out for the next 30 years, unless you make some major changes.
Yeah, but the thing is, Dan, we know this. The clients don't have any idea the level of risk they have, none. Because when we actually, again, convert this to dollars and cents, any client in their right mind, if they're relying on their assets for income to supplement their other income sources like Social Security, they know if they lose 20, 30, or 40%, it's going to devastate their retirement. Their dreams are going to vanish, and they're going to be in a very, very odd predicament because now they're down $300,000, $400,000, $500,000, $600,000, $700,000. It took them 35 years to earn this money. Now all of a sudden they lost a big chunk of it in a matter of weeks or months if this market has a drawdown.
Well, and one of the big things is when you look at the stock market going up and up and up and hitting new heights, It makes people feel like, hey, I'm invincible. Nothing can happen. It's going to keep going up until it stops going up, which we've seen a tremendous amount of volatility, and we will continue to see a tremendous amount of volatility. One of the other statements in here, quote, is from Warren Buffett. And I like this because he says, risk comes from not knowing what you're doing.
Yeah.
And that makes sense because we have to know what we're doing before we can now feel certain. And every client that comes and sits in front of us, or couple, they sit in front of us and they all think they've made mistakes. They all think they should have made better decisions. They all think they should have saved more. And they all think other people know more about their money than they do. And the reason why we have a very, very successful company, Jim, is because people at retirement have no idea, literally across the board, what to do with their money to reduce or eliminate losses from stock market volatility, and then create a very high level of income that will not run out for as long as they live. They just don't know how to do it. They were really good because they had to be good at saving. Otherwise, they don't get in front of us. They have to have assets. But once they get here, what's the story?
Well, the story is they have no idea how to do that. They think they've been told that they can take 4% out of the portfolio or in that range and they're going to be fine. But they have really no idea how sophisticated someone has to be in order to, at our level, to actually design a full plan, an income plan, a tax plan, a legacy plan, understand your risk, your fees, understand each one of your income sources, whether those income sources go up or where they go down, where they vanish. Is income guaranteed? Is it not guaranteed? All that has to be laid out very skillfully with an extreme amount of retirement knowledge by your advisor in order for your plan to have any chance of success. And just having your money invested in a diversified portfolio doesn't do that, Dan. It just doesn't.
No, I had a client come in maybe about a month and a half ago, and he had went to his current broker, a big, huge national firm. Everyone would know the name of the firm, and they had about $3 million, and they wanted to find out how much can we safely take out of our assets for income without it running out. So with $3 million, they came back and they said, we really think we need $10,000. Can we take it? And their advisor says, oh yeah, you can take $10,000. And they said, great. And they said, well, what's the chance of a run out? He said, oh, you have a high probability. You have an 80% chance it'll last. You have a 20% chance it'll run out. I'm like, okay, 80% is a high probability, but do you really want 20% chance? And the client said, no. So I said, what if then we dropped it to $90,000 a year, which is about $7,500 a month, and it increased the probability to 92%. And the client said, that still seems like I don't want 8% chance I'm going to lose. So he said, okay, what would we need to do to have a 97% chance that our money won't run out? And it came back, they can take out 2% or $60,000 a year, $5,000 a month, which was half the amount they thought they could, and it still might run out.
Yeah, and we probably could get them on a very conservative portfolio design, maybe triple that?
200,000.
Yeah, 200,000. That's the difference, folks, because again, we're income planners, we're risk mitigators. We do those two things in our firm. Our job is to get your risk down substantially from how you currently are invested if you're in the market. And number two, hopefully significantly increase your income. But we can't do that again unless we control your risk. Dan, you're talking about risk. I read several articles this week. And if you just take two of the probably most well-known investors in the world, one is Warren Buffett. And Warren Buffett, right now, he has this little indicator, and his indicator that he's been using for the last 50 or 60 years determines if the market is undervalued, if it's fairly valued, or if it's overvalued. And right now, his indicator says the market's about 250% overvalued based on his indicator, because his indicator is, if you put it in numerals and numbers, it's 80. That's where the market is fairly valued. And it's right now, I think, by 218%. Which means that's almost triple, 2.5 times greater than where he thinks it should be.
One is because his indicator is based on rational financial decisions, based on, are the companies profitable? What's the chance things are going to continue on, which is how he bases his investments, versus irrational behavior, which is happening now, where there's already $17 trillion of future profits of the AI boom built into the market. That means the AI stock should not go up any further until we have $17 trillion more actual value in the companies, which that's going to take a long time to do that. So I think it comes down to rational versus irrational right now. Everything in the market is saying, if you're fully exposed in the market, which so many of you are, it's irrational. And studies came out in the last 6 months, and they basically are pointing towards the next financial crisis that happens, like 2001 and 2, 2007, 8, 9, will be the single worst financial catastrophe for retirees and soon to be retirees. Not everyone else, but for retirees and soon to be retirees, even worse than the Great Depression, it's predicted, because retirees and soon to be retirees now are at the point where they're no longer saving. They have what they have of assets, and they are, for the most part, so grossly over risked in their portfolio that if the market crashes, they're going to probably lose between 40 and 60% of their assets.
Yep.
How will they ever recover from that?
They're not going to, and people are becoming so complacent. And the reason for it, Dan, is that if you go back through history to 1929, the Great Depression, we've seen 17 bear markets, a bear market whereby the market goes down by 20% or greater. And if you actually just average that out, that means every 5 years on average, the market goes down about 39%. It takes about a year and a half to hit the bottom. It drags on the bottom, and it takes, well, whatever time it takes to get back, right? It's been almost 18 years since we've seen really a bear market of any magnitude. That was in 2008 and 2009. So people think this market, Dan, is going to continue to drag up and drag up and drag out. They don't think it's going to drag down, and it will. It will be significant. People will realize what happened. How did I put myself in this position? But they can reposition themselves right now, Dan, if they know how to do that correctly.
You're back with Dan Allman and Jim Files, the Peak Financial Freedom Hour. And we'd like to welcome all the listeners back and thank you for joining us. And I'm going to hit back to the Warren Buffett quote, and that is, risk comes from not knowing what you're doing. Right now, as you're sitting here, if you're retired or getting ready to retire, what you know about your money is what you've been taught by whoever has given you that information. Maybe it's an advisor, a previous advisors, or multiple people. Maybe it's your 401k. Maybe it's just reading a lot of articles. Maybe it's your friends. But ultimately, all you know is what you've been taught. And unfortunately, what you've been taught, for the most part, not 100%, but for the most part, probably 99%, is how is the best way to accumulate the maximum of assets for retirement. And if you look at probability wise, the best way to accumulate assets for retirement, we agree, is to take more risk. It's okay to have volatility, invest in the stock market, stay invested. You're in it for the long run. Everything will work out over the long run as long as you're not taking income distribution. So we agree that you should have been as aggressive as your gut would have allowed you to be up until you retired, and really up until 5 years before you retired. Once you get to this point, though, you have to now modify the way you're looking at things, because number one, the biggest one, is you don't have time on your side. It doesn't matter what you think. There's like a little hourglass that we have to look at and say, okay, we don't have time on our side to make up those types of losses. And you're not going to make up the losses probability wise if you also are taking income distributions. If you're not taking income distributions, the stock market has always recovered 100% of the time, even after the Great Depression. If you're taking income distributions, it's very, very difficult, if not sometimes impossible, to recover from those types of losses.
You know, Dan, we have a chart that we often show clients just to clarify this point. And we say, okay, let's say you're 65 today, you're a couple, and let's go back 24 years. Let's assume that you retired in year 2000. That would mean you lived 24 years in retirement, you died at 89, right? So you go back to 2000, and we said, okay, what if your broker or you believe you can take out 5% in a distribution annually, and you have a high probability you'll never run out of money? So again, you're going to live 24 years in retirement based on my analysis here. If you go through that analysis and take 5% out and you're paying, industry standard fees, your money would have run out in about 12 to 12 and a half years. You would have been broke. You have no money and you have no income because, and Dan, you talked about this earlier. When you're in asset accumulation, you're making contributions to your retirement plan, right? You're putting money into your retirement plan. But when you're retirement, you're taking money out of your retirement plan and you're not putting any money in your retirement plan. So when the market does come back, which it did between 2000 and 2024, we had some significant growth years, but it doesn't really matter. When you're taking out income, when the market's going down, it's very, very difficult to recover. Very difficult.
Well, and you think about why it ends up being pretty simple, in that when you're suffering a loss and taking out income, it's a double whammy. It's a literal double whammy, because let's say the stock market goes down 20% and you lose 20% of your assets, and then you're taking out 5%. Well, now your assets have gone down by actually more than 25% because of the compounded nature of it. But can you imagine now, sitting here a year down the road, you've only taken out 5% and you have less than 75% of your assets left? It's going to cause you intuitively to know that things are probably not going to work out. So you can't be in that type of position. And that's why we think it's always the most important thing to have is an actual plan. And we know we're talking to you right now, and we'll say, you need an actual plan for retirement. And most people say, I have a plan. Well, you have an investment or you have an account, but we know with high probability, you do not have what we consider an actual written plan. And we know this because in the last 40 years, if we've met with over 4,000 people, only 3 people have had an actual plan that we would consider a viable, responsible plan that will help them be in the best position to make decisions for retirement. Every one of our clients gets a plan because we don't do any type of investments, any type of recommendations unless we have a plan in place. And the plan now has to be in writing. They have to have it in their hands, and it has to really, cover several areas. And we'll just look at the simple thing. It has to cover risk, so we understand what that means. Decreased risk has to cover where their income is going to come from, has to cover fees, needs to cover taxes and how much tax they're going to pay. And for those that want to know, and most of them want to know, it has to do with legacy. And if you can have a plan in writing that covers all those things for the first time, what does that do for people?
It really blows people away because they've never really understood it this way. They've never been educated on this. They've never been taught. They have no idea that you can put together an income plan, a tax plan, and a legacy plan that's actually going to work. It allows us to look out 30 years. We can tell you at year 17, are you going to be short on the cash flow? Isn't that important to know right now so that we can modify portfolios and adjust things before that happens? And with a plan, you can do that. Everybody listening right now, if you have over $1 million in assets, you all have a trust. If you don't, you're thinking about getting a living trust, right? So you go to your attorney, you sit down with them. 2 months later, you got a living trust. You pay them $2,500 to $3,500. You got yourself a trust. You're really excited because you finally have a trust in place. You have a plan for your beneficiaries. That's what it is. It's a plan for your beneficiaries. But you haven't thought through the process of saying, okay, that's fine for my beneficiary, but what about my spouse and I? Shouldn't I have a plan? That's what we do, Dan. We are putting together a very sophisticated plan that's easy to understand so that we can guide you through your life. The trust is to guide your money through somebody else's life, right? After you're gone, you need a plan for your life.
Well, and the reason why people just don't have a plan is they don't think it's available because there's very few firms, if any, that will provide you with an actual written plan with all those things we talked about: your risk, your income, your taxes, your fees, your legacy. When we look across the nation, I haven't found one firm in the 40 years I've been in business that does what we do when it comes to putting every single little thing about someone's money in writing. And that's key because we find it's the only way the consumers, you, can stop worrying about your money so much is by making sure every single little thing's in writing. And you just didn't know you could get it. So if you don't know you could get it, you never think about it. You think, gosh, I don't know how to make all these decisions, but you have no idea that you can actually have the decisions made for you in a written plan that gives you the highest probability everything's going to work for as long as you live. You're back with Dan and Jim, the Peak Financial Freedom Hour, and I'd like to thank you for joining us. Today, we're talking about the overall subjects of really the most important thing for you, and that is to have an actual plan. We're talking about risk, of course. We're talking about how to create income, and we're talking about taxes and fees and having a legacy plan to pass on money. But you need to have something that ties all those things together in writing. Otherwise, you're going to be hoping and wishing that everything works out and that you're going to get lucky. And the majority of people that have retired or getting ready to retire, they have no idea if they should or could. They just hope it and then they do it. Because how many clients do you meet, Jim, that have already retired and have retired without a plan? 100%, right?
Every one of them. Every one of them. Maybe one that we've seen, maybe two, every one of them. And that's, Dan, it's so hard for us to communicate this through radio because people listen to us all the time. We talk about a plan, a plan, a plan, a plan. It's really difficult because if you're not seeing our plan, it's really hard for you to digest what we're saying. But if you actually sat down with us and we walked you through a custom plan for you and if you're married, your spouse, and you could actually see your true risk, how much you could lose based on historical benchmarks, right? If the market goes down 5, 10, 15, 20, 30, 40, 50%, how much you can actually make if the market goes up, what your visible fees are and what your invisible fees are. But more importantly than that is how is your income going to be dispersed to you by all these varying income sources that you'll have in retirement? and all those income sources guaranteed or not guaranteed, and will you run out of money? And the beauty about our plans is that we can provide you tax advice. We can tell you on an after-tax basis, after you pay federal and state income taxes, and we'll show you exactly what that is based on the plan, how much is left over, and then we can adjust the budget for inflation. So we can tell you 10 years, 20 years, 30 years out, with inflation going up and increasing your budget, is your after-tax income going to be suitable to maintain your lifestyle? We can show you all that stuff, Dan. And when people see that, it blows them away because they've never, ever seen anything like this before.
No, and I think a lot of people don't think that it's available because no one else is offering this. We're going to build a plan. If you can imagine, just in your mind, we're going to build a plan that'll show you where your income is going to come from each individual source for the next 30 years. Wouldn't that be cool to see it kind of now, helping you understand where your paychecks are going to be replaced by? So it makes it nice. Then, more importantly, because of my tax background, we're able to do tax analysis for you and show you every income source coming in, how much tax you're going to pay, what percentage of tax you're going to pay, meaning what's your tax rate, after subtracting out your budget, knowing each month how much excess money you have. Just think of that. If you knew what your income is going to be, how much tax you're going to pay, what your budget is, and how much extra you have per month, doesn't that now allow you to feel very comfortable that retirement's going to work as long as that plan is in writing? And that's the whole goal. If we keep it that simple, just in writing, what is the excess month income you have? And it really doesn't matter when you retire, the amount of your assets, as long as your plan works. What matters is how much excess monthly income do you have after paying your budget. So we really focus on that and help you do that. Give you a quick example. Clients came in, they had about an $8,000 budget. Before, when they were working, they were making about $11,000 a month net. And so they were doing well after all taxes. We put a plan together and we're going to give them $15,000 a month of net income when they retire. And they're only going to be at a 25% federal and state bracket, which means 15% federal, 10% state, which they love. But now above their base budget, they have $7,000 more to spend, or $84,000 more per year. And in their base budget, they didn't put much for travel, Jim. And we have clients that take 2, 3, 4 big trips a year. They could spend $80,000 if they do something like that.
They can, but also you might spend that for 5, 6, 7, 8 years while you can comfortably travel. But then all of a sudden, if you continue to get $6, 7, 8, $9,000 of excess cash flow above your budget, what can you do with that? Well, you can start saving it. Maybe you don't have long-term care insurance, and maybe you're worried about that. So what you do is you start saving maybe 30 or 40% of that money. Maybe 50% of that money goes into a bank account or into CDs or treasury bills, safe and secure, knowing that you're going to increase your bank account every year for the next 15, 20, 25 years, so that if you do need emergency money, if one of you or both spouses need long-term care, you have the cash to do it. It's not in the market, because the market can go up or down. This is secure money to allow you to maintain a lifestyle that you want to maintain, even if you need assisted living in the future, Dan. And people love that way when we put together a cash flow plan that allows them to plan for those types of circumstances in the future.
Yeah, I just did a plan similar to this one where we created enough income above their budget after taxes, where we saved money for their long-term care because they'd had long-term care before. The premiums got too expensive from whoever they bought it from, and they canceled it. So we need to save a big pile of money. I call it their long-term care war chest. If they use it, great for long-term care. If not, it's just passed on to beneficiaries. But at the same time, each year we had enough net income that they're going to start gifting money to their 2 kids now, rather than wait 30 years down the road when they pass away, because everyone knows it's way harder on our kids than it was for us. So we can then create a plan based on what each individual person or couple wants their money to do for them. And it just frees them. It takes away all the stress and the 2,000 pounds that are on their shoulders right now by having, again, a written plan. And when we talk about, risk reduction, I know a lot of people on the other end listening are saying, okay, that means I'm not going to get good rates of return. My money's going to dwindle and nothing good's going to happen. Well, right now we're at a really unique place in the economy and the financial markets, in that we can use some of the conservative assets that we will use as part of one of our buckets. And right now get anywhere from 7, 8, 9, 10, 11, even 12% guaranteed lifetime payout rates on those dollars, depending on how the plan's set up and depending on how long we're deferring taking income out. But if you can get between 7 and 12% guaranteed for as long as you live, how can someone really beat that?
We don't know you can beat it. That's why we're using them not only for our clients, but we're using it for our own family money for the same reasons. Is that if you can get those distribution rates, right? Those aren't return rates, those are actually cash flow distribution rates guaranteed for the rest of your lives. We've not seen it this high in decades, Dan, and it's not going to stay this forever because all this stuff is interest rate sensitive. But for the time being, the distribution rates are just phenomenal.
You're back with Dan and Jim, Peak Financial Freedom Hour. And I'd like to thank you for listening to us and staying with us today. Let's look at questions that people should be asking their advisor, and what might the answers be. One of the big ones people want to ask is, how do you get paid? And what they really want to know is there going to be a big commission deducted from my investment with you and then paid to you directly or to your firm? Or is there other ways to get paid where I don't have to give up those types of dollars? And any of the plans we use, there's not going to be a commission deducted from your assets for us to get paid, where they're paid from the large insurance companies, from the money managers we work with, but there's going to be no front end load on those dollars. The second one is then, Jim, do you operate in a fiduciary capacity at all times?
100% yes. We are fiduciaries to our advisory clients. We always have been, which means we have to put your interest above ours or our company's. We have to make sure that we have the ability to prove behind the scenes that your interest becomes before ours. And that is why we're doing plans. That is why saying you're a fiduciary is meaningless, Dan, unless you can prove that you put your clients in their best
Well,
interest.
what's the only way you can prove that?
In a written plan.
In written plan.
That's
if anybody gives you, even fiduciaries, verbal, you never believe anybody in today's wacko world ever. You don't believe Jim. You don't believe me. I tell every client, Jim tells every client, do not trust us until you trust your plan. Once you trust your plan, then you can trust us. And that's why we have really good clients. How about this one then? What's your process for building income in retirement? Well, ours is a very comprehensive scenario and process, but it's very simple, I believe. The first step of the process is to determine how much income you need, which is done through a budget. That's the single most important document. Single most important part of the plan is figuring out what is your budget. And we need to know not what the tight budget is, but what I call the golden retirement budget, meaning how much money do you need coming in each month to make sure you're not worrying about the amount coming in, because then you don't think you'll spend more than that. So we first build out the budget. Then we build out the risk metrics, and we find out how much risk you have now, how much risk you want to take, and then build a plan that reduces your risk, because almost all of you are going to be taking significantly more risk. So get the risk down, because at retirement, Jim, if you take higher risk, you basically can get a higher rate of return, but the higher risk you take, the lower amount of income you can take out. Is that right?
Yeah, and people don't really understand that. But I'll give you an example. Let's just say you're taking high risk and you think you can take high income out. And let's say this year the market's up 22% and you're lucky enough and where you made 22%. So you're really happy. So all of a sudden you adjust your income distribution. You're going to take out 7 or 8 or 9% because you made 20%. Makes all the sense in the world. But next year the market goes down 20%. What happens if you took out 7, 8, or 9% in distributions? It went up 20, but now it's down 20. What happens to your plan long term? The answer is it's going to blow up. It'll blow up really, really quickly if you have 2 or 3 years of bad or even flat market. So the more money you're going to make, which means the more risk you're going to take, the less amount of income you can take out.
So if you said, what is our overall philosophy for building income? We want to always focus on the assets you need to create income for. We want to reduce or preferably eliminate losses from any type of stock market volatility on the assets you need to create income from. Then we're going to create the highest level of income we can get out of that asset, as long as it's going to last, to be guaranteed to last for as long as you live. And after we prove it in a tax projection that you won't be in a very high tax bracket. If we can do those, that's our entire philosophy about income. And it's what every single client wants. They just don't know they can get it. How about, what's our philosophy on risk management?
Well, risk management kind of is divided into our whole philosophy of putting money into buckets. And we really divide money into 3 buckets. These aren't the same 3 buckets you may have heard about on the internet, or maybe your advisor's talking about. These are 3 buckets designed by Dan and I. It's a bucket in cash, which is CDs, treasury bills, savings accounts, etc. Safe, secure. The market goes down, you cannot lose any money. There's money in the market, but we're using risk mitigation strategies, which mitigate the risk. It doesn't get rid of the risk, but it tries to mitigate the risk. And then we have a bucket whereby we use it and we put it into a financial instrument where you have no market risk at all and you have a high level of income, and that income is guaranteed for your life. And if you're married, for both of your lives. And by doing that, by dividing money strictly up into buckets, rather than just diversify the portfolio with stocks and bonds, minimizes your risk significantly and increases your income.
No, I think that's perfect. And risk management has to be included in your plan if you're retired or within 5 years away from retirement. And it can't just be, oh, we're going to diversify your assets amongst these stocks and bonds or these mutual funds. And don't worry, you're in it for the long run. Hang in there and ride it out. The philosophy in risk management has to be at this point of your life, you cannot suffer a large loss, no matter what. That's why we created the golden rule of 5 to 10% that states even if you lose 50%, or even if the market loses 50%, you better not be in a position to lose more than 5 to 10% if the market crashes. And 95% of our clients have a 5% or lower overall risk of loss. And we put that in writing that even if the market crashes 50%, they need to plan on still having a loss, but we want it to be 5% or less. So it's just the philosophy of reducing risk, because everyone knows if they suffer 50%, they're not going to make it. It doesn't matter. If they lose 5%, there's a high probability nothing negative is going to happen in their retirement. How about this one? Do you incorporate taxes into your planning? And most advisors have to say no, because by law, if they're not a tax planner or certified, they cannot do tax planning. I was an enrolled agent with the IRS for 30 years. I'm an accredited tax advisor as well as a certified financial planner. So we do incorporate income tax planning into our plans, where we're going to show what's the best option. Is it better, like most people think incorrectly, that we should defer our IRAs until 73 and then just take out the minimum distributions? Well, the longer we defer, the more taxes you're going to be paying on the minimum distributions when you're older and less likely to spend the money. How about how much income am I going to have each month net after taxes? Right now, if clients come in, when they were working, they grossed a certain amount and they netted about 50%, meaning after taxes, after 401ks, after pensions, after Social Security. So when they come in now, we tell them, hey, you're going to generate this amount of income, $240,000 of income. They think they're going to give up $120,000 of that. They think they're going to get half. But if we design a plan that gives them $20,000 a month, they're going to end up having probably about $16,000 a month, which means we're going to keep about 80% of their gross income as net income once they retire, and it makes retirement a lot happier for them.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.